Good afternoon and welcome, good evening, whichever part of the world you are in. Thank you so much for taking time to join us this afternoon for an overview. And the typical, as the topic suggests, the typical dilemma that every NRI has in his mind is, should I be, keeping my monies in dollars or should I keep it in rupees? And the dilemma is such because in dollar terms, the dollar seems to appreciate vis-a-vis the rupee. So there is one advantage that I get. But really the savings in itself, be it in the bank or anywhere else, is reasonably low from a dollar perspective or any other foreign currency, any other major foreign currency is very, very low savings rate, 1%, 2% and thereabouts, right? On the other hand, if I were to move money into rupees, then I have a feeling that I will suffer depreciation because the dollar tends to appreciate vis-a-vis the rupee. Second is that I'm not really sure is India doing well, not well, so on and so forth. I am abroad, my money is down in India. Is there an opportunity I see of India doing well? The news that we seem to hear is a lot more negative from an Indian context. So that also kind of puts pressure on us. We're constantly saying, I mean, is there anything well happening in India? Because a lot of things are bad, including the COVID second wave and so on and so forth. So that's where the confusion comes about. So I want to kind of place some facts and some thoughts that we have vis-a-vis what we believe can be a good India story, a very reasonable India story over the next 10 years. And that's what we're going to share. So with your permission, I'm going to share the slide presentation that I have for this. So I'm going to, if I may request all of us to be on mute, it will be great. So I owe this presentation to Motilal Oswal. A lot of these data points I have kind of liberally taken from their presentation. So I believe anything that is good needs to be appreciated, and the way to appreciate it is to use that data. So this is a thing. So a lot of the way we all look at the future is to look at the past and how the past is played out, and that gives us a fairly good idea about how the future is likely to play out in some sense. So it's always important to look at the immediate past of how things have happened, and so we've chosen to look at the Indian economy per se over the last 10 years as a kind of from a market, from a stock market perspective, the Bombay Stock Exchange Index perspective, it's not been a great 10 years so far. I mean, I know that we are now slightly higher than these levels of 49,000, but in a larger scheme of things, it's not been great, especially if you look at 2016, 2017, 2018, of course, to March of 2019, there was a big drop in the stock market globally also, and India as well. So really, from a 20,000 points in 2011, we have reached about 49, 50, 52,000 points, about 10, 11% on the whole, which is nothing great from an India perspective, primarily because in India, we already have a 4.5% inflation, which means if you take that inflation out, this is really a very poor growth rate in the last 10 years. But part of the reason is also because we had a lot of things that have happened ever since 2014. We've had a demonetization event, which kind of cut the economic cycle big way. Then we had a financial crisis. IL&FS, a large financial institution, went down under. Then, of course, you had a GST implemented across. So the earlier taxation regime changed and GST was introduced. A huge disruption, all of these. For a country like Singapore or Malaysia, it took about a decade to get their GST right. So we have gone through a cycle where something like a GST kind of did take an impact. And of course, even before we could come out of our GST problems, we had a COVID that came and hit. So the last, at least half of the last decade hasn't been a great time for India per se, in terms of economic growth. A lot of disruptions, a lot of changes that kind of hit us. Uh, how was the last decade for India vis-a-vis China or the rest of the world? Obviously, as against the rest of the world, we were growing much faster. But China is really the leader of the last 10 years. It's kind of done a stupendous growth from a $6 trillion economy to a 13, 14 trillion economy. So we're really very far away from where it is, where they are. But this gives us a lot of confidence that when we reach a certain milestone of numbers, which we will discuss later, we also can share the growth rate as much as what China did at that point in time. So that's where the excitement for a lot of us comes. The next 10 years is likely to be a time of tremendous change and opportunity in India, and which is what we want to kind of bring to you in some sense. So today, India is where China was in 2006, right? And in the last 14, 15 years, China has transformed itself into about 3x of its size, from a $2.9 trillion economy. It's kind of a 2 point odd trillion economy. It's now moved to about $14 trillion economy. So it's really kind of 3 to 12 is 4 times, and this is slightly more than 4 times. So in the last 15 years, China has been able to move that through a tremendous amount of growth and drive that they've been possible, which is the opportunity that lies ahead for a country like India if we can get our act together, which is what I'm going to kind of lead to. So as a result, the next $1 trillion opportunity for India, and just to look at how India has been performing economically over the last 10 years. So the first, in the global cycle, global economy, $1 trillion is a lot of money, and that's a very important milestone that most economists chase. So for instance, India took 58 years to get to its first trillion, but the next trillion happened in 7 years time, and thereafter, thereafter, if you notice, every $1 trillion is coming at the rate of about 3 years. Of course, the third $1 trillion is still in the coming, because we got impacted by 2 things. One is, like I mentioned earlier, we had the GST interruptions, and we had interruptions due to the demonetization and a lot of other things. So the third trillion took a little longer than what was expected. But I think we make up for time. So the next, fourth and the fifth trillion, which are expected to happen 3 years later, may happen much faster as well. So India can, in that sense, frog leap the growth rates that we are planning or predicting to happen, primarily because now everything is set. The GST is set. There is no more experimentation that's happening on that. So once we are out of COVID, I think the next level of growth will kind of take off. Every time GST, this $1 trillion gets added, what is the advantage is that the per capita goes up. So from a GDP per capita of $1,000, if India moves to a GDP per capita of $3,000, which is what will happen if we have the kind of growth that we saw, then the significant part is, if you notice in this has 3 elements to it. So one is what is called the basics, kind of spending, which is what consists of, your food, your basic clothing, and whatever you require for your daily life. Then you have a discretionary, and then you have a basic savings that you do. So typically on $1,000, 600 of that dollars goes towards our basic needs of daily living. Your dal, roti, chawal, and all of it, and your basic clothing will take care of that. 300 we also need to save, and Indians are good at saving. We need to buy our properties, or we need to save. So 300 rupees goes. So the discretionary spending that we have is only limited to 100 rupees. What is discretionary? What do I, do I go out and buy, say, an expensive clothes? I go to a mall, I visit, I want to watch a movie with my family, I go to a fine dining restaurant. All that is today limited to 100 in the Indian context. Now imagine when we go to $3,000 at the end of, say, 7 to 10 years time now, or even earlier, uh, that 600 will move to about 750, which means your basic living expense will go marginally up. Your savings will also go up significantly. But really the big thing that will happen is that people's propensity to spend money goes up tenfold. And once people have enough money, they will spend it on luxuries, they will spend it on goods, they will spend it on travel, they will spend it on other things. So we do expect a large part of the economy to benefit out of this big change that we are going to see in the next decade. So you will see a lot more luxury goods facing India, the Zaras of the world, and so on and so forth. So 10 years down, you will see there will be no big brand that will be outside of India. Everybody will be facing Indians because Indians will have more money to spend, more disposable income to spend. So it presents a great opportunity from an economic standpoint. Let's look at if we can be, what are the factors which kind of point to the direction where India will be a reasonably large superpower. I think one is, of course, we are a democracy. There are negatives to democracy. There is a lot of criticism that democracy is slow, but democracy is democracy. So we see a seamless, movement of political power. So Congress is there in power one day, election is over, next day BJP comes in. There is no halla-bolla, there's nothing. In Tamil Nadu, where we are currently doing this call from, ADMK ran the government for 10 years. And election is over, DMK comes in, there's absolutely no issues. Next morning, DMK is functioning without any trace. So there's a lot of charm in democracy, but it is not well appreciated. Of course, we have a very good federal structure. What we mean is there are three arms which run the country. One is the government, the other is the bureaucracy, that is the bureaucrats who support the government, and third is the judiciary. All these three have to work in sync, but each of them are also independent minded. So the government, the judiciary doesn't need to always listen to the government and judiciary kind of are complementary in each other. So there are lots of different structures that operate at various levels. And of course, we are, with the introduction of GST, we have a one nation idea. So there's one income tax, one GST, Aadhaar, so the data and digitalization at a country level is almost done. Everything is linked to one another. Your Aadhaar is linked to your income tax, it's linked to your telephone, it's linked to your bank account. So we do see a very positive play that's going to happen out of all these aspects once the market gets on. Of course, apart from democracy, the other thing is demography. What do we mean by demography? It's a population. And how is the population set? Arguably, the largest country with the largest population below the age of 50, 85% or 90% of our population below the age of 50. Why is it significant? Because below the age of 50 is normally considered as the consumption age. People go out, eat, buy, stay, live, car. Everything has a fallout when you have a large population below 50. So we have a tremendous advantage from that perspective that we have a large population. In fact, the largest population below the age of 50 is in the world is currently in India, and that's a huge domestic market. So the reason is, for instance, Thailand, if tourists don't visit Thailand, Thailand as an economy will suffer. India doesn't have any such challenges. So if all Indians get up in the morning and have a breakfast, lunch, and dinner and go back to sleep, we have a very, very large thriving market within that itself. So we don't need to actually look outside. I mean, it'll be great if we can get more, but really that. The other more exciting news is we have a large middle class, and our middle class itself is larger than many of the countries put together. Right? Our middle class is larger than Europe at 200 plus million people, households. It's larger than all of Europe put together, right? And that has a large purchasing power. The upper end of our middle class itself is about $16 million as we, or $16 million, 60 million families as we speak now. That can move to about 168. So the point which is alluded to is that the middle class, the ability, the purchasing power of the middle class is growing significantly as we go along. Over the next 10 years, you're going to see a lot more people in the middle class move to the upper end of the middle class. If you take the middle class as a segment, they will move to the upper end. And in the upper end, they have the ability to spend. They are having a lot more money. So that's going to be a big, big, big positive for Indian economy as a whole. Right? And if more people purchase, more people have taxes, more people pay taxes, more money in the hands of the government to do more projects, and more business happens all through. Third is digitization. Like I said, we arguably have we are the software export capital of the world. I mean, everybody acknowledges this. We have one of the largest telecom networks, the largest collection of smartphones. And in many ways, we are second only to China, and a very close second, I must say. And our costs are ridiculously low on many of these things, both in the internet and the mobile telephoning space. The costs that India operates and is a fraction of the global cost. So we are very, very cost competitive, yet we have a large base as well. And third, we do some fantastic stuff. For instance, we have, apart from MasterCard and Visa, we have our own domestic, card company called RuPay, which is a creation locally. So RuPay is almost as good as MasterCard and Visa, if not better. The only company in the world that competes with Master and Visa is RuPay. No other country is attempted to do. Second is, we have a digital payment system, a government-run PayPal, as we may call it, that is unparalleled in the world. So we have something called NPCI, National Payments Corporation of India, that is generated a payment system that today rivals the world. In fact, our consultants today operate and provide consulting to players like US on matters relating to payments and stuff like that. So we have tremendous advantage in all this, and we believe those can kind of be game changers as we go along. I'm going to go a little fast. So like I said, when India announced its liberalization in 1991, we were left with $4 billion in our bank account. We are now upwards of about $650 billion in our bank account, and growing at the rate of about $12 to $15 billion every month at that rate. Of course, we are also spending. We import a lot of oil, so we spend a lot of money. But net, we still have a huge dollar surplus in our Forex reserves. And declining interest rates. One of the reasons why economic growth will be very, very good is when interest rates kind of decline over a period of time, and that we see a great potential to happen. We believe that it offers a great advantage, competitive advantage for Indian industry to kind of go out there and kind of provide compete in the global market, so to say. So that's that. Crude is, of course, declining. Like I mentioned, it went through a phase where crude was at an all-time low earlier. Of course, coupled with the kind of difficulty due to COVID and so on and so forth, crude prices did come down. It's again inched up a bit, but with the electric vehicles coming in and so on and so forth, we don't think crude is going to be such a big hit from an India context. In the past, crude has been a major spoiler for Indian economy, but I think those days are behind us largely. So that's my view. I'm almost done. A government is looking at minimum government, maximum governance. You're seeing a lot of privatization, banks are being merged, banks are being kind of moved to private. There are lots of Air India is on the block to be privatized, LIC is on the block to be privatized. So there is a bit happening towards making the economy more efficient, primarily because I think the government also realizes that a large growth is waiting to happen if we kind of handle this space well. And that's really the action that is happening. So to conclude broadly, India is fast moving, adding like I said, $1 trillion in shorter periods, maybe in 2.5 years. Going forward, every 2.5 years we'll add $1 trillion. So we expect to be a $5 trillion very soon, maybe less than 5 years or thereabouts from where we are. And thereafter, the growth is going to be pretty spectacular, as we believe. And key indicators, like I said, is democracy, demographics, and digitalization. Of course, COVID did kind of put a temporary block. We are coming out. All the cities in India are back on its feet. Most of them don't have large COVID lockdowns anymore. Some industries continue to be under stress. The cinema industry is continuing under stress because no theaters are operational. The malls can't operate many places. So those things continue, but by and large, I think COVID, we are largely out of it. I think the next 6 to 9 months, we'll be fully out of it, hopefully. So in the next 10 years, we believe Sensex, the Bombay Stock Exchange Index, the stock market index can be 4x from where we are. We are roughly about 52,000 points now. We expect it to be about 2 lakh points in 10 years' time. That's 4 times. It's a phenomenal growth. And it's entirely possible. I mean, of course, we are taking a bet into the future. Anything can happen, but we believe strong case for that. There's a lot of value migration happening in IT, private banks, life insurance. A lot of private sector players have entered auto, consumer durables, paints. So lots of areas where there's a lot of private players who are adding tremendous value, and those values are going to translate into a huge valuation opportunity for all of them. So India may take a little time and may have taken a little time to get to where we are, but I think we remain very positive that next decade, India will show a tremendous amount of opportunity and growth, and we would like to extend that opportunity to people outside Indians who are living abroad and outside of India to take advantage as well. So that's it from me, and I'd now kind of request my colleague Bhuvaneshwari to take stage and give a quick presentation on the product side, and then we are open for question and answers. Hope that's okay with all of you all. With your permission, I'd like to kind of have Bhuvaneshwari get started. Over to you, Bhuvaneshwari.
Thank you, sir. Thanks a lot. And good evening to everyone. Just a few minutes, I'll be sharing my okay. So once you have started, like once you have mindset of investments, so the first thing we need to check what are the categories available for the investments. Babu sir, I think I'm audible, right?
You're audible, Bhuvaneshwari.
Okay. So once we are like set a mindset, like we need to check what are the categories available in the mutual funds for starting our investments. So first thing is categories are basically they are categorized into as per the investor's needs, financial goals, and requirements. So as per that, our categories, it has been categorized. So it is a broad categorization of equity, debt, money market, gold. So equity is another subdivided by the large, mid and small, multi-cap and sector oriented. So large, mid and multi-cap are based on their market caps. Like if the particular sector has like stock has more than 20 to 20,000 crores and more, it will be considered to be the large cap. And mid cap, it is considered to be if a market cap is about 5,000 crores and less than 20,000 crores. So this is considered to be the mid cap, and it is small cap. Small cap is something where the market categorization is between 5,000 to less than 5,000. So, and the multi-cap is the last category where it will be a combination of large, mid, and small. So large cap is something where they would be concentrating on the big size companies. If you take a fund of a large cap, they would be having a maximum exposure of around 80% into a large cap. So when you go into a mid cap, it would be considered as a more risky, as they would be concentrating on very small size companies. And if you check the portfolio, the allocation will be around 65% into a mid cap segments. And when you go with a small cap, it is also like, as they are concentrating on less than 5,000 crores market capitalization. So it would be more riskier when you compare with large and mid. But the thing is, the potential into this particular segment would be more. But for investment purpose, when you're looking for a long-term segment, you can very well go into this particular category. Multi-cap is something which is a combination of all, like large, mid, and small. When someone is looking for around 3 to 5 years or something, so you need not to diversify by yourself. You can just take a multi-cap fund, just invest, hold it, and you can hold it for 5 years, and it can go. So multi-cap is something you if you wanted to have a safer play in the market, you can go with a multi-cap fund. Or if you want to take a risk and when you are planning to hold it for more than 5 to 10 years or something, you can very well go with the mid and small cap combinations too. So I have given the example of what are the large cap stocks, like example IT. If you take an IT, Infosys and TCS, and if you take a banking, all banking stocks, almost HDFC, ICICI, Kotak could be coming under this. So these are the examples. If you look into it itself, you'll be able to identify what are the large cap, mid cap, and small cap stocks. And the next segments would be the debt fund. Debt fund would be suitable when you're looking for, like, I just wanted to park it for a period of around 6 months or something. I just wanted to have in returns more than that of a savings bank account. Very well, you can go ahead with the debt funds. Debt funds would be a combination of debentures, government securities, corporate bonds, which have a maturity period of 91 days would be considered to be very short-term debt. Like if you're looking for very short-term, like I just wanted to park only for 3 months or something, you can just go with a liquid fund where you can compare your returns only with your savings bank account. When you're looking for more than 6 months to 1 year of tenure, you can go with ultra short duration funds or money market funds. These are especially for very short term. They doesn't have any exit load except liquid fund. They don't have around 7 days. Apart from that, after that, you won't be having that. So this is especially for short term. And short-term duration and medium duration are especially if you are planning to hold it for like minimum 2 to 3 years or something, you can just go with short-term duration and medium-term duration. And medium to long-term duration and long-term duration, these are all for the investors, those who are planning to hold it for more than 3 to 5 years. For example, there will be a person like retirees. If for them we cannot give them a risky fund, we cannot ask them to go for a mid cap or a small cap where the volatile would be more. With them, ask them to park it for a long-term debt fund so that they don't have any equity exposure. They won't have much volatile like a debt fund. They completely into a debt category where the volatile would be very less and their money would be safe, and as well as liquidity would be there. So this is especially for if you wanted to have very safer play in the market, you can just go with the debt category. This is the returns I have taken for each category, like small cap, mid cap, and multi cap. So you can see the return wise, last 1 year, 3 years, and 5 years would be the best time to check the returns. So last 1 year, actually the market were good. So you can see the returns were more than 50% in all the categories: small cap, mid cap, multi cap, flexi, and large. So as the number you are able to see, the returns would be as per the risk also. Small cap, if you are ready to take risk, you can get a tremendous returns. But the thing is, your investment tenure should be a long term. It is better because the volatile would be more here. And mid cap, you can see last 1 year is 76 and last 10 years is 16.68. So this shows that if you stay in a market for more than 5 years or 10 years, you can get a tremendous returns than that of holding in a FDs or a savings bank account or elsewhere. So this would be like you can be in a safer side if you're holding it for a longer tenure also. So if you take last 5 to 10 years market, anyway would have seen like minimum 2 ups and 2 downs. So whenever your investment is there for 2 ups and 2 downs, you can very well see a good returns for your investments. So, and down you can see the debt category. Debt category, I have already said, this is only for the safer play. Or if you want to have a combination of equity and debt also, well and good, you can very well go ahead. Because generally when we do a diversification portfolio, like when we create a portfolio, we generally diversify between among debt and equity as per the investor's age, requirement and tenure. So it would be a combination and you have to go. And the last category I just wanted to give you is about the gold. Gold investments, like we have 2 set of golds. Either we can buy a physical gold, or if you doesn't want to go with the physical gold, we have an option of buying a gold in like a mutual fund or an ETF. We have both options. The only thing is gold, you need to hold it for a longer tenure. Or what you need to do is once you see a returns, either you need to come out or you need to like hold it for a long term. It cannot be used for a short term purpose. So it's a one type of, for diversification purpose, you can use gold investments. And why diversification? So I have shown this. So in this chart, we can see that all the categories may not be performing all the time. At one point of time, if you see mid cap would be performing good. At one point of time, you can see large cap would be performing good. Hence, generally, when you go for an investment, diversification is very must. So you need not to concentrate on any one segment. You should concentrate on almost all the segments. Like it should be a basket of all. So diversification is more important. Another thing is your investment should not be a pure equity, or your investment should not be a complete fixed income, like a short-term debt. It should be a combination of both. So at any one point of time, if we have seen last year, almost market went down by 25,000 points. So if your portfolio was at around 60-40 or something, debt funds have given double-digit returns. So your portfolio would have balanced by a debt funds. So equity funds, definitely they would be negative last year. So this year almost they have come up, but in order at the downside, debt funds would be balancing your portfolio. So in this sense, it should be always a combination of both. And that's it. So if you have any queries, just let me know. Thank you.
Thank you, Bhuvaneshwari, for that quick, I think almost a rapid fire, quick glimpse at the mutual fund industry in India and how we have different categories and classifications. This was just going to give you a broad highlight that India remains an exciting market in terms of the opportunities that it presents, both in what you call short term as well as in long term, both across various risk profiles. So this is broadly it, and I'm open. We're all open, me and Bhuvaneshwari, for any questions that you may have. So so please feel free to unmute yourself and then ask if you have any questions.
Yeah, good evening. I have got one query.
Yes, sir.
Yeah, this is myself is Venkat.
Yes.
This is regarding this in mutual fund. We have got SIP.
Yeah.
Same thing. We have got another one, a periodical withdrawal fund.
Yeah.
So what is the type and how it's? Can you share some highlight on this thing?
So typically, I'm going to give it with an example. So I'm just going to mute Mr. Yeah. So typically, when you let's say you're a 40-year-old person who is kind of wanting to retire at the age of 60, a SIP is a good way to create a retirement corpus. So you put aside, say, 20,000, 40,000, 60,000, as per whatever is your liquidity need. You put aside, you can build a reasonably large corpus over the 10 years or 15 years or 20 years to your retirement. That's what systematic investment plan is. You put a set of money. The systematic withdrawal which you spoke about is nothing but after you've created that corpus, you want to take out money. So if you have been doing, say, as an example, I'm just giving you an example. If you did 40,000 rupees worth of SIP and you created a certain corpus, say, in 20 years time, at the end of 20 years, that corpus you can use to withdraw, say, as an example, 80,000 rupees every month for the next 20 years or 30 years, as the case may be, of your life. So one is to create the corpus, because on your way to retirement, you want to create a corpus. And after retirement, you want to live from that corpus. So you withdraw from that. So that's what this SIP is, systematic investment plan, the route to creating that corpus. SWP is systematic withdrawal plan, the route to use that money coming out after you retire to take money out for daily living. That's the route. I hope I have clarified.
Yeah, that's great. Thank you. But one thing is whether that amount is a fixed amount or it will be varying.
You have to define, sir. So once you have a corpus, you will define that amount. So as an example, what we do is if that corpus is say 1 crore rupees, as an example, I'm just putting a number to it. Then we give a 6% withdrawal per annum from that corpus. And that translates to about 50,000 rupees of cash flow coming to that individual every month. So, which means that the corpus will continue to grow, assuming that the underlying investments will generate about 8% or 9%, as the case may be. You will still have 2% more adding to the corpus. So the corpus is going to continue to grow. Plus, you're going to have the ability to, draw out 6%, which is about 50,000 rupees per month for your post-retirement life as well. So that's how it is. But you define that amount.
Okay. That's great. Thank you, sir. Thank you.
Yeah, thank you.
Yeah, good evening, sir. This is Ashok.
Yes, Mr. Ashok.
Sir, actually, I would like to know, like any formula, I'm just, written from US to India for good. Okay. And I would like to see some kind of formula with my age and with my savings, how much I need to invest, each bucket. Okay. So, each financial concerns has its own formula, right? So I would like to know, is there any, for example, in IT industry, right, to calculate our salaries, actually, we used to say, your experience into 2, right? So if that is a salary, then you're in good position, right? So like that, if I have my age and I have this much, I have 1,000 rupees in my hand. So in which bucket I need to put it across, right? So if I have some kind of formula like that, so that it is easy for us, to calculate and put it into the bucket, right? Whether it is a large equity or equity, mid cap or large cap, kind of thing. So is there any kind of formula so that we can put it across and define ourselves, sir?
So there are two formulas I will tell you. I don't know how relevant it will be. So generally, when you are younger, and I don't know the age profile you are in, but generally normally when we consider cash flow planning, what we do is, what we normally say is 25% of your salary will go towards your regular living, right? 25 to 30%. 25 to 30% will be for your, kind of luxuries which you want to spend. We looked at in the presentation, right? Some, you want to go out and eat, you want to buy some fine clothes and so on and so forth. 25% will go towards your taxes and 25% will go towards your savings. This is broadly the numbers when you start your career, when you grow. Now, what typically happens is, as every 10 years, your salary and your earnings go up significantly. So when you start your career at 20, 30, 40, and 50, these numbers change quite dramatically. So for a 50-year-old person, these calculations will be very different, because when you start your career, 25% of your money goes towards your basic living. but your basic living doesn't change over a period of time. I mean, what you have for breakfast doesn't change much. So all those items remaining the same. So your cost of living continues to remain where they are, whereas your propensity to save goes up. So what we find that when people reach 45 or 50 years or thereabouts, they are probably saving about 60, 65 or 70% of their salaries as savings. And that's what you need to root for when you are in that age. When you're younger, you have more expenses and your overall kitty is much smaller. As you grow older, your propensity to save and therefore invest is much, much larger as well. So that's one rule of thumb broadly, is that is your ability to save or invest doubling every 10 years is one key aspect that one needs to check. Other is from an investment perspective, for every 100 rupees or dollars or whatever it is that you're investing, one of the rule of thumb that we look at for investors, and it's just a rule of thumb, is 100 minus your age should be your equity bucket. If you were to look at your investment as bucket comprising of equity and debt, your bucket must consist of 100 minus the age should be your equity bucket, which means if you're, say, a 30-year-old person and 100 minus 30, 70% of your portfolio must be in equity related assets or assets that can take a little bit of a risk but can generate a much higher return. Why do we say that? Because at 30, you still have about 30 more years to retire. So your income is going to continue to come. You have a longish period to kind of wait for return. So you are willing to take that risk and wait for that risk to play out. Similarly, if 70 is going to go to equity, 30 needs to be in safe buckets. It is debt and safe instruments, primarily for providing liquidity if you need it. So this is again a rule of thumb that if you are 100 minus the age, will be your equity bucket. Now, of course, there are people who look at the bucket as you grow older. At 50, also we find that there are people who are doing 70% in equity because the age and life expectancy is now gone up. So instead of people looking at, post-retirement 10 years, 15 years, now people have to look at 30 years post-retirement of cash flow because people are easily living to 90, 85, 90 is quite common nowadays. So which means there could be a way in which you look at this formula as 120 minus your age is your equity, which means even if you're a 50-year-old person, 70% of your money can be in equity, provided you are comfortable with it from your risk appetite perspective. So these are two formulas very easily that I can tell you, but if there's anything in specific, we can discuss offline or at a future point in time. But very important, sir, to understand that no two human beings are the same. So all these rule of thumbs are very broad parameters, but between two human beings, a lot of different things we all have. So I would like you to just consider these as, rule of thumbs, but you will have to take your assessment and we can guide you in that process in terms of with a questionnaire or a few questions that will help us understand and then give you a better judgment.
Thank you, sir. One more question, sir. Actually, I've been following up with a lot of financial constants over this, 6 months once I, back to India. So everybody's, focusing on market only, right? So mutual funds, equity, and this is the only, instruments we have to invest, or do we have something else, some other different ideas, we can, invest? I'm just curious to ask because anything goes right, everything falls to market only finally. So, is there any other ideas or any other thing we can invest and that's what I thought of asking.
So I will divide the pie into two broad categories. Everybody's investments around the world, and this is not just India, around the world, the pie can be of two ways, right? One is what we call the fixed assets. One is called the liquid assets. All investments have to fall into one of these two categories. In fixed assets, it's all about real estate and land and so on and so forth. Given that the last 5-10 years, India and in general and Chennai in particular hasn't done really well on that segment, there is a lot more interest in stock market now. That's all. I'm not for a minute saying that that's not an interesting space.
Right.
just that the recent past, the last few years haven't been a great return. And in some sense, the people don't see a great value there. Now, coming to the liquid investments, by that we mean these don't have a fixed structure. They can easily be changed from one to another. There you have plethora of opportunities. I mean, there are a million things you can do with money on the liquid side, starting from a simple bank deposit to a cryptocurrency investing on the other end of the curve, right? So everything is wide open, except that while bank deposit is safe to that extent that if you put money in a bank and the bank goes bust, up to 5 lakhs, Indian government guarantees you back, right? So you will at least get 5 lakhs rupees. On the other end of the risk is cryptocurrency, right? So you put money into crypto, boom, something happens and you lose it. There is nobody you can ask. There's no regulator. I mean, globally, there is nobody you can go and find out why it went bust or if it went bust at all. And equally true of the returns, right? So 5 years back, if you had put money in something like a Bitcoin, you're probably laughing all the way to the bank now. So all these investments exist within the framework. Having said that, I think why people are coming back into market or mutual fund is there is a certain visibility that is available there. I mean, why did I spend time talking to you about market is there is some logic and there's some visibility that I see in markets, which I don't see with other things. For instance, cryptocurrency, I don't know if it's a sham or is it the next big thing. It's not very easy. So if would I recommend my customers to have 70% of their money in cryptocurrency? No. Can they do a 3%, 2%, 5% in that? Sure, but with the caveat that everything can go bust and they may not make even 1 rupee out of it. That's possible. So those are the extremes, and there are lots of products in between. There are bonds, there are debentures, there are lots of things. Sorry. The only thing in all this is a lot of these structures aren't tax efficient in the Indian context today. So you end up paying 30% tax on a lot of this, whereas in mutual funds, the taxation is more benign. So which is why it keeps coming back to either a mutual fund or an equity, primarily from a taxation perspective. That's all. Does that answer your question, Mr. Ashok?
Yes, yeah, of course. Thank you so much, sir.
Yes, sir. Any other questions that we can be? So we'd be very happy. So we have Bhuneshwari is now our head of our NRI desk, and she's going to be reaching out to you. We'd be very happy to do a one-on-one with you over a Zoom or any which format that works for you, to understand if there's something that we can be of help to you, and we're very delighted to kind of work with you as well. So do let us know. I mean, if there is any questions, you can always write to us. Our email IDs are there with you, and we would kind of send you a mail at the end of this session as well. We believe there's a tremendous opportunity in the next 10 years in India from an economic standpoint, and that can translate in multiple ways. The ways that are, easy and relevant for investors is passively to benefit from this is to look at investments in mutual funds and so on and so forth, which is what we spoke about. But we believe it's a good opportunity. At least some portion of your money needs to be looked at from that perspective. And we'd be very happy to kind of partner with you and play a role in this. We'd be available on this. So every Friday around this time or sometime, every third Friday of the month, we are wanting to keep it as an NRI specific day. And we want to kind of reach out and do. We have a reasonable base of NRIs, but we want to do more in terms of, reaching out and making sure that our message gets out to a lot more. So if you have friends, do kind of give them a shout that they can kind of reach out, and anything that we can be of help, we'd be most delighted. Once again, thank you so much for sparing time. And if there is no more questions, then we'd like to call it a day. Wish you a very, very happy weekend. We are on a Friday evening, so all the very best and stay safe. from COVID and look forward. We will be in touch. Like I mentioned, Bhuvneshwari will be writing to you and setting up a call. We'll be very happy to come on a one-on-one call and discuss specifics of if there's some role for us to play in your investment journey. Once again, this is Babu Krishnamurthy, the Chief Sherpa at Finsherpa Investments, and have a lovely weekend. Thank you.
Yeah, thank you, sir. Thank you.
Thank you. Thank you, sir.
Thanks a lot, sir.
Bye.